Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'm going to sprinkle in my opinion as we go. It's generally going to be commodity, financial topics, and or wealth building related topics. So let's dive in. Let's see what people are talking about. If you want to follow me, it's at finding_finance. Or if you want to join our community, finding-value.com. We do have a discount going on for Black Friday. Check out the description link below. The discount is turkey, and there's discounts on both the monthly and yearly memberships. So going back down, we've got Trend Spider, bullish and bearish divergence cheat sheet. So here's the cheat sheet. What I'm going to do is I'm going to try to find some of these. We've got like a double bottom here, moving on up. We've got ones where you've got the lows coming on up. So it's angled upward. Some of these are angled upward, which is bearish, double tops, stuff like that. So basically, it's a double bottom. It's just one bottom is moved higher or lower than the other and or equal. Now, if we were to look at these and try to find these types of patterns, and I've already pulled one up, here's Global Copper Miners ETF, COPX. There's that double bottom. That double bottom is this right here, the medium, equal low. And then what occurs is you get a consolidation here, and then a big run up generally occurs. Now, that's not just the only one that I see in the markets. You can go to REMX. That's also one with a slight lowering below it. This is called the slingshot. The slingshot, I don't know, I made that up, the slingshot cheetah, but usually you get like a double bottom. It breaks down below, gets everyone scared. Oh, it's going to break lower. And then it slingshots back to the upside. This here is your flag patterns. And then it just keeps going on up. And then we've got another big flag pattern. So that is it's three up waves. 1, 2, 3, 4, 5. 3 up waves. A big consolidation. And the consolidation is another flag. So this is a big flag. And we could see a big move to the upside in REMX, most likely called the third wave. And it'll go up in a 3-wave up wave, 2 down waves. So it'll most likely go like this. Something like that. Much like it did the first wave here. We also see it in coming on up. It was REMX, COPX. We've got XOP, which is just a different pattern. That's a shoulder, head, shoulder, inverted head and shoulders. Not the same as the double bottoms, but we've got patterns across the entire commodity complex that are bottoming bullish patterns. On the other side, we could be putting in, and I don't know for sure, topping patterns in like the S&P 500. So if you notice, it's like we just took all those graphs and flipped them upside down, and this could be a topping pattern that I'm looking for. Now that topping pattern can be where you get it comes up, it comes back, and then it does this. Sometimes they come up and it basically does a double top. And sometimes you can even get one where it comes up and comes up like that. All of those are bearish formations, and it's a strong bearish, equal high, and then a lower high and higher high. So it's generally a bearish configuration. It won't go down forever. And I'm not saying that this is going to be a topping pattern that tops out forever. But what occurs is something like this. So you get like, it comes on up, you get like a peak, you get a second top, and then it rolls all the way back down. Then it comes back up. This is your double top, then it comes back down. And then eventually you'll break through that resistance and go into a much, much higher elevated state as you go. So this is I'm seeing these in regular stocks, and I'm seeing these in all the commodity stocks. So when we go and you look at those big charts where you get topping patterns versus bottoming patterns, in some sectors, some will be bottoming, in other sectors, they could be topping. And that's the money rotation in the system. That's the market conditions determining where and how money flows. And right now, with the increasing interest rates or interest rates that are elevated, it's causing a rotation of money into different assets, just like we've seen every other time in history in commodity bull markets and precious metals bull markets. Martin says, we apparently don't need commodities anymore. Hey, deflation forever crowd. It's structural. Underinvest in stuff, get stuff inflation. This is why we will return to low inflation crowd is going to get shocked. Excellent chart from brilliant friend Tavi Costa. And basically, commodity producers, the CAPEX cycle adjusted for GDP. It's the aggregate trailing 12-month CAPEX in millions of dollars. There's that double top that we saw again, the rollover, and we are way down here in relationship to CAPEX and how much money is going into go into these commodity producers. Now, you could also look at this chart, and I'm going to draw it on a different one. But to me, it looks something like it's basically, and I'm just going to move this over and get a fresh sheet here. So in this dark spot up here, it looks like to me, if we were to look at this and the way that this has fallen, it looks like you have three big humps, 1, 2, 3, and it's in a falling wedge pattern. If you look, here's the first hump, the second hump, and then the third hump. And then if you draw a line through here, you get a falling wedge right to a corner. What does that mean? It means that most likely it's going to reverse to the upside, and people are going to start to spend more CAPEX when the price goes up. It's coming. It is coming. So that's what we've got there on that one. The uranium bull is doing a breakout into the next up leg, supported by media awareness and rising popularity, and of course, by the superior fundamentals showing the increasing supply deficit for uranium, with the need for overfeeding to fill the needs of utilities. It says you want to buy before the mania, and you want to sell into the greed. Do not wait for this new paradigm. I'm fine with waiting for it. I'm even fine selling it on the back end of this, on the bull trap. I'm fine selling back here. It means that you've basically extracted everything and it's probably had a sharp sell-off. I'd sell it somewhere in denial or return to normal. Probably more like denial or new paradigm is where I would try to sell it. I think that we're probably located in the first sell-off. We're just coming out of the first sell-off. And some of these are coming out of the bear track. Some of the exploration companies are still way down there. I mean, way down there. And then there's the developers have kind of moved off, and then Camco and Kazatomprom are making new 52-week highs. So they're at different stages, and that is signaling where we're at in this stage. Generally, institutional investors are gonna pick up Camco and some of these bigger ones, and they're moving first, and that's why they're moving first. Big money comes into the big names first. So I would be looking at the smaller guys, just waiting. But I think we're probably going to be entering the media attention phase at some point soon. The tough part is everyone is so, I'll say, mixed into, like, let's say they're on Twitter. They subscribe to everyone who talks uranium if you're interested in uranium. So you're seeing uranium stuff day in and day out just because you're paying attention to it and you're watching it. When you have to worry is when the people who don't pay attention to it start talking about the price of oil, the price of uranium, the price of commodities. That is generally when you need to get concerned. It's not about people who have been following this. Like if I'm talking about uranium, I've been following this for at least since 2019, 2020. And I've been kind of riding this whole thing the entire way. If you're following me, I'm going to be talking about the things that are cheap. But when I stop talking about uranium and telling you guys it's going to get expensive, or it is expensive, that's when I would start to get worried, I should say. Here's URNM adjusted for Camco. I thought that was kind of an interesting chart here. I've tried to make a chart where we compare the rest of uranium miners in the URNM and measure it in Camco shares. It is clear that the rest of the miners is trying to start to outperform Camco, which is exactly what you would want to see. So we're coming on down in this falling wedge, and we've broken out to the upside. We're doing a retest right now. And what does that mean? It means that URNM and maybe even some of the smaller exploration developers are going to start lighting it up here. This is where it's going to get really fun if people are in those more speculative companies, because I think money's going to start to come in here at some point and start to rip it. The retail guys aren't here yet. I know we probably look at each other and say, "Hey, we're retail." No, we're just guys who like uranium. The people who are just going to chase price performance have not showed up yet because they haven't started moving enough for the FOMO to kick in for those guys. So we're real cheap. We could see an outperformance of URNM or a lot of those speculative companies. We can replicate that chart too. We can go URNM divided by CCJ and then hit this. And there's the chart that we've got here for it. And we can throw a trend line through here, which is about there. And then we can throw a trend line through this, which is about there. So that's the chart there. We've got the falling wedge. This to me looks like URNM is about to outperform Camco. You can see the big buying pressure days and then the small little flag pattern that's most likely going to rip to the upside. This is where things get very fun for those who've been riding it from the bottom like me. My account values went ballistic in 2020, 2021. And then it cooled off, consolidated, and now I'm ready for this thing to rip again. And it's already moved up quite a bit, some of those companies, but I think it's really going to move. And if we get an outperformance, up here, that's almost doubling the price of URNM will be going up at 2 times the pace of Camco almost. If we go to about 1 all the way to about 2, it's a little less than 2x, the pace of Camco. Jesse says, over time, there's been a relationship with higher inflation leading to lower multiples. To compensate for the way that inflation would eat into equity returns, stock investors had better hope that this disinflation is immaculate. So you can see the valuation. And if you get sticky inflation, if your core PCE inflation is around 5, where we've been basically at, this is the cyclically adjusted price to earnings ratio, and we are way overvalued. This should be all the way down here on the historical basis when the core PCE inflation is around 5. What this is inflation kicks up, and then your interest rates kick up. And when your interest rates kick up, the net present value calculations change. And that's where these should be priced lower. These here are in bubble territory. So what they're hoping for is they're hoping that the inflation comes back to this level where they reside over here at the 2% level and have a high valuation. I'm in the camp where we might come back a little bit in core PCE, but then I think we're going to come back forward and move to the right with higher rates of inflation. The reason I think that is because we've got a lot of homes that we need to build, and that's going to be inflationary. And that inflation is going to come into the system. It's going to put pressure, upward pressure on interest rates, and interest rates are going to reprice these assets. These assets haven't been repriced yet. They've only repriced a little bit lower, not down to levels like we've seen in history. So they are extremely overvalued at this time for where interest rates are located. CCJ going for completion of the reverse symmetry move target, second target. My best guess is a consolidation at around that level. A lot of that money is possibly flowing into smaller caps, uranium stocks. They are going to flow into smaller caps, but here it is moving on up. The first target, if you can look, it's just a downtrend line that we've broken here. It's been moving on up, and the second target's going to be this high up there at about $49. I think we're going to break all of it. I think we're going to break all of it. We could be left with a gigantic cup, and then maybe we create a handle on the right-hand side and then break that as well. And we've got a gigantic cup and handle. which then even moves to a much larger level, which would be the bottom of this to the neckline or cup line, and then project that upward, and we're going to get some ridiculous pricing mechanism. Depending if we're on logarithmic, it's way higher because this went down to a very low level, and that's at $50. It's much like the size of the silver cup and handle that could potentially occur. This is insane. Win recession. Car dealers can't sell overpriced cars and trucks. And this person says win recession. If they can't sell anything, we're already in a recession. It's already slow. So the question then is, when do we come out of it? When do we get through it? So a lot of the charts, when I look at these things, they're already slowed down. They've already got their big move to the downside. The question next is, when are they going to start going back up? And that's why we need charts to basically tell us when money starts flowing back into the markets. Mainstream media refuses to show you this Bitcoin. We've got a bear market, bear market, bear market in the beginning. We've got these accumulation phases and then a bull market. This guy is saying that we could potentially be in an accumulation phase before a bull market. What do you guys think? Do you think that's what the case is? I'd like to hear your opinion. It says, good morning from Germany, where citizens have increased their savings rate again. Now, generally speaking, when the savings rate increases, that could be a bad thing. That's generally money coming out of the system and getting parked somewhere because people are afraid. During slowdowns, the saving rates go up. During expansion, during phases where you get these inflation kind of pulses, generally the savings rate goes down. So that's kind of what we've seen in history, and you can see the savings rate go up. It was actually going up in 2000 to 2008, which is weird, but this is Germany. It's not America, and it's not the dollar. So this could go a little bit different than what the dollar does and people in America are doing. This is gold to the moon, Alice, to the moon. So again, this is your big base. We broke out of that base. This was your top. We created another base. We created another base. And we're breaking out of that base right now. How big are we going to go? I don't know. We'll find out on gold. I think we're going to go much higher. We were told capitalism would make cost of goods and cost of living cheaper. A rising tide would lift all boats. So please explain what's going on in America. We don't have capitalism. Capitalism is, what's required of capitalism is to have floating interest rates that that basically tells you price signals and the price of and cost of money. They're controlling 50% of every transaction through the interest rates and the quantity of money in circulation. So we don't have capitalism in a free market where you've got someone controlling the money supply and the interest rate. When they control the money supply and the interest rate, it controls 50% of every transaction that occurs in that currency. Because when you go and you buy something, 50% is the dollar usually being transacted, at least in America. So the goods are going down. It's just the money and the stimulus and the deficit spending is overpowering capitalism. It's overpowering our productivity. And that's just your M2 money supply divided by GDP. And they're going to lie about the GDP, and they're going to lie about the productivity, and they're going to lie about all these different things. Most of the measuring sticks that they use, like consumer price index, they do hedonic adjustments, they do substitutions, they do all sorts of stuff to manipulate the number. So that's why it's government and Federal Reserve banks manipulating everything. XLF, we have a 3-year wedge breakout, MACD bull cross, closed the week at the highs. You can't say financials don't look hot. I also was looking at KRE. KRE is breaking to the upside as well. So why are the financials looking good? And why do the home builders also follow this XLF? They're all breaking to the upside. Because we're going to go into a housing market boom. There's going to be increased lending, and the financial sector is going to make more money from that lending. We could also pull back on interest rates. which would also help their holdings of bonds. That's why I think they could go on fire here. Banks are preparing for a storm, says QE Infinity, although XLF is breaking to the upside. Bank lending has flipped negative on a year-on-year basis. This is consistent with many prior instances of financial turmoil. But sure, nothing to worry about. Well, I'm going to make this comment here. We're basically at zero. But every time you got around this level, that's a time you want to buy, not sell. So this is a good time to buy, not sell. And that's also why XLF is breaking to the upside. So bank lending is probably bottomed or very close to bottoming. And I think people are positioning for that bottom. Maybe something's coming with lower interest rates or something like that. There's there's over 500% appreciation potential in the TSXV Metals Exploration Index to just get back to its high 16 years ago, when gold was even lower than today. I'm confident that the explorers will be going much higher than they did back then in the coming gold bull market. What makes it timely is that December is the best month on average for the TSXV over its 21-year history. This is followed by January and February, the next best months. For my taste, now is the perfect time to be adding money to this segment of the mining industry. Meanwhile, one should be wary of the crowded trades that masses are chasing today. Today's mega cap tech bubble is even bigger than the 2000 internet bubble in terms of enterprise value to GDP. AI euphoria is a good contrarian reason to consider selling these stocks now. And there's 2024 recession. Maybe we can pull on back here, 2001 recession. And that's probably what's going to occur. It's that double top that we were talking about earlier. Personally, I think momentum chasing investors are getting led to the slaughter ahead of a highly likely stagflationary recession. All that I see is here is the right-hand side of a massive head and shoulders valuation pattern in the Magnificent Seven with substantial downside risk. Shoulder, head, shoulder. Potential downside risk. To me, it looks like a bull trap. So you get a peak, it comes down, pulls up, that's a bull trap, and then it traps everyone and it's just going to smoke them on the downside. The largest market cap company in the world, Apple, is trading at an insanely high 7 times sales. Its top line growth has already been stalling out for 4 quarters in a row. In and of itself, this is an indicator of an incipient recession. That's enterprise value to sales versus revenue growth, ready to hit to the downside. And that's what he's got to share there. But I do agree, I think gold's a really good spot to be. And potentially, if you look here, that is an inverted head and shoulders that we could be putting in. You could also say it's a double bottom. If you throw something across here, it's a double bottom. URA, 9 years breakout. Look at this thing, guys. Nice little pattern. That's where I usually draw a trend line. It's where this guy bottoms, comes up, comes down, hits it, and we're just starting to break out right now for URA. This is going to get real interesting here, and we could see a big run. Big run. Gold. I've already talked about this one, so we'll end it there, guys. That's what we've got. Uranium's looking really good. Looks really good. The overall markets, they could be topping at some point. Maybe they got a little bit more left in them to the upside before rolling over. But I agree with, I'd say, most of what people are saying here. Commodities are cheap. We're breaking bottoming patterns. We've got bottoming patterns that are inverted head and shoulders on energy and stuff like that. We're breaking uranium patterns. Everything looks really good. All you have to do is sit and wait. That's it. Sit and wait for these things to appreciate if you're already in them. That's all I'm doing. Give me a thumb up for the content, subscribe to the channel, and we'll catch you guys next time. This is Finding Value.